maybe not many people know this, but for that integration, Spark was actually one of the main LPs into that Bitcoin borrow product, supplying, I think it was upwards of like 80-90% at one point as it grew from like 0 to 600 million in the months after the launch.
Regardless of market cycles, we're getting increasingly uncorrelated in terms of the size of the deposits to the market trend. So even though the market is getting more and more bear from a crypto native perspective, but the total number of deposits have been very steadily growing. If we do our job well, we won't even hear about, on-chain infrastructure. We won't hear about DeFi in general. Where we really want to be is what HTTPS is to internet, but Morpho to the wall of credit. So it will just be so invisible and plug in to distribution networks across the world.
Hello everyone, my name is Momir. I'm managing partner at IOSG Ventures, and this is OFR podcast, which is hosted by IOSG. Today we have two guests from the money market space. We have Sean from Morpho Protocol. She's APEC lead over there, and we have Sam from Spark Finance. He's the co-founder at Spark. It's great to have you both here in Hong Kong. Welcome. And maybe we can start with some brief introductions. Sean, do you want to start?
Sure. Thanks for having me. I'm Sean. So I lead all of our growth efforts here in APEC for Morpho. And Morpho is a neutral credit infrastructure. On one side, we allow users to get yield on stablecoins. And on the other side, you allow people to get financing.
Sam?
Thanks for having us. So I'm Sam McPherson. I work for Spark, and we have been founded out of the Maker ecosystem originally. So Maker has, amongst the rebrand to Sky, has also segmented its governance process so that Sky acts as a wholesale lender. Spark functions more as like a commercial bank, issuing loans across the DeFi, CeFi, and TradFi.
Yeah, thanks. And I think with the first question, maybe we can start from Sam. You've been in this space since 2020, right? From Maker to Sky rebrand now to Spark, co-founding Spark Protocol. Can you just give us perspective on the evolution on the money market space and the role your projects have played in this evolution? Obviously, it's been a long journey from original Compound, Land, Aave, and then Morpho entering the story. So how do you see this evolution, and how do you see the role of the Spark in this broader landscape?
Right. So when I joined Maker back in 2020, the lending that was going on was EP lending, which is isolated market lending against ETH and Bitcoin collateral. So how it's evolved, as you mentioned, Compound formed this pooled lending model originally. And so then Aave also came in with this pooled model. And so we launched Sparkland, which is a similar pooled lending model against ETH, Bitcoin, and LSTs. We've launched this in 2023, and it's now the second largest pooled lending market in the space. We've had a lot of growth even recently. We are a significant holder of ETH at 500K total deposits in the market. What does Spark do? It's evolved over the years. We started as some of the issues we saw with CDP lending in the original Maker model is the cross-collateralization was an important feature, as well as the ability to rehypothecate the assets. In particular, ETH, we saw with Lido becoming more significant, there was a lot of demand for people getting yield on their ETH. So this liquid ETH yield product, we saw this was coming and was going to be quite popular. So we originally launched Sparkland as sort of a product to serve the markets that we weren't serving with the CDP model. And so we've had a lot of success in growing the protocol. Now, though, we've moved into a lot of different types of lending. So we do lending on Morpho as well. Integrating DeFi markets in general. We also do OTC Bitcoin lending through Anchorage Custodian now as well. We have now a vaults product. So this is called Spark Savings. So this is able to allocate freely not only the DeFi lending markets, but also to RWAs. So our goal there is to provide highly liquid, SOFR base yield, a relatively conservative yield in the space at a high scale. More recently, we've also launched a CD5 prime brokerage that we're in the process of scaling up. So this allows margining across not only DeFi positions, but also centralized exchanges, hyperliquid, other decentralized exchanges, and now increasingly getting support for TradFi with the popularity of stocks. Like right now, having this sort of access is incredibly important.
Got it. And Shan, I guess Morpho has proven that this first mover advantage is not necessarily critical. You guys entered the space a little bit later than other players, but you managed to climb the ranking and now be one of the leaders in this space. So can you give a brief overview of how do you see the space evolving and the role that Morpho has played in transforming the direction of this space?
Yeah, I would say that actually Morpho first started as an optimizer layer that was built on top of the DeFi 1.0 protocols, so Aave and Compound. And building on top of those protocols, I think our biggest learning was that the protocol layer and risk should be entirely separate, and risk should be managed by professional risk curators that are closest to the market. And this fundamentally changed how we think about Morpho and how and what the first version of Morpho will look like. So we transformed completely from a monolithic lending structure to a permissionless infrastructure. And with this infrastructure, it allowed institutions to be able to have better control that they're able to build on top of us, right? So Coinbase, Robinhood, a great examples, Apollo, SocGen. And I would say the most interesting development and the one that we're most excited about now is Morpho Midnight. So fixed rate, fixed term markets. That's the one we've just launched a month ago. We're going I would say we're slowly fully rolling out right now across different chains and different markets. But I would say that easily, really easily 100x the addressable market, way beyond just crypto-backed loans.
I see. And I guess when we try to position Spark versus Morpho, to some extent, it seems that the right abstraction would be to say opinionated versus unopinionated infrastructure. I guess you guys are taking more direct role in terms of the underwriting the risk of the borrowers, whereas Morpho has emphasized this story of relying on teams like yourself and other curators to basically take this opinionated stance and focus only on the infrastructure. Do you think that this would be a good way to describe this relationship, or do you think also that Spark is taking part in this infrastructure game as well?
Yeah, so the relationship is mostly collaborative. Morpho's more like infrastructure, and this differs from other lending markets in the space where there is a curator attached to it or somebody doing risk management. So for us, it's a perfect fit because we want to do the risk management ourselves, and we also want access to these isolated markets, for RWAs and stuff like that. We don't, Sparkland is specifically for DeFi lending. And so we want to just have it in that specific use case. But we also want to do lending against RWAs, which I agree with Shan, it's going to be a huge market. And so we partner with Morpho for this to use their infrastructure to do isolated markets for RWA lending.
I see. What about you, Shan? How do you think about this relationship? And at the end of the day, Morpho, I guess, even with the new products, would still try to remain unopinionated financial infrastructure. So can you share a little bit more about the reasoning behind such decision to stick to the infrastructure only?
Well, I would say our thesis is really simple. What we want to tackle is building the credit infrastructure for the world. And for the entire world of credit, that's huge. That's 200 trillion. So crypto is a very small, tiny fraction of it. We have started with crypto-backed loans because it has the strongest product market fit, right? Every user on both sides of trade are already on chain. So we started from there, but I would say our ambitions are way more than just crypto-backed loans. There will be so many more different categories as more and more RWA cases come on chain. And every subcategory of RWA requires very different level of risk underwriting. Account receivables is going to look super different from your tokenized gold, your tokenized stocks. So we need to bring more and more sophisticated risk curators, asset managers on chain, where they will underwrite all of these new asset classes. And that's the segment that we want to serve. And being the neutral infrastructure just allows them a lot more control into building the better products that they need. Yeah, but I would say just to add to Sam's point, Spark has been a great partner of ours. We're very closely ever since Morpho Blue and now Morpho Midnight.
Tend to agree, like the overall like broader digital asset space needs like more exogenous assets in order to be able to scale. I think right now we're still stuck at somewhere around 300 billion stablecoin market cap, and I feel like with exogenous crypto yield opportunities, it's probably very hard to imagine scaling this beyond 500. So I think in that sense, like the expanding towards like either private credit or like other sorts of credit or like more RWA assets like equity and stocks, it's very important in my view. And in terms of like expanding into this like first category of RWA, which is like some sort of like a private credit and yield earning opportunities, it seems that so far like Morpho is perceived as a clear leader in this game. Like at least when we look into the partnerships you guys announced, like obviously starting with some crypto native institutions like Coinbase, but now also Robinhood. Then there were also like very big private credit providers that partner with Morpho. In general, like it seems that competing in DeFi native versus institutional RWA game is also very different and requires like a different set of skill set. How come like Morpho has been so good, I guess, in the institutional game, especially considering that you guys also have like a very crypto native, DeFi native roots, like this jump towards the institutional, I guess like it wasn't that easy. So how did you guys manage to basically prepare for the institutional wave?
I would say it starts from product design. The product design itself, the architecture is what institutions need. I've mentioned control many times, but control extends to so many different service area, right? Control on underlying collateral, control on how the private keys are being hosted, control on which chain they want to launch this on, control on KYC, compliance. I would say the sales cycle for crypto native and institutions are completely different. So internally, we are we have different sub-teams that target different categories, right? For the crypto native folks, they optimize for best rates on chain. So they go wherever best rates are. They're very fast. They move very quickly. That still can happen in days or hours when the market is good and when there's a good opportunity. But for institutions, the sales cycles are much longer. If anywhere between like 8 months to 12 months is fast. If not, it starts from years. And you're not just selling to a single decision maker. You're selling to the entire org, usually like a mix of 5 different 6 internal teams. And then you check off the box one by one, what the business case is. Have you taken off a compliance angle? Do you have the product toolkit? So I think internally we are very well scoped out, strong GTM team that really cracks into each and every need of what the institution wants. And then we align our product roadmap together. So yeah, it takes time, but that's also where I would say the much larger addressable market is.
In Sam, I often hear about like this commentary when talking about some of the emerging, like maybe even like new money market protocols that are trying to kind of build their edge. Like a lot of people are critical, saying that, for example, like some teams have like very crypto native edge, but then now we are in a kind of institutional era of crypto, and therefore, like despite some of the teams being extremely strong in the crypto native space, it's very hard for them to go beyond this, right? And then they would say like, oh, look at Morpho investing so much in institutional GTM. How could these new players compete in this regard? How do you think about like, because obviously there is some bias now, we are in some sort of like a crypto native bear cycle, which is more isolated, and then people tend to kind of value more these external opportunities, and institutions are something that seems much, relatively speaking, much better opportunity right now. But do you think this is just like biased temporary thinking, or is there like potential for crypto native to come back and be competitive in itself, or do you think that for the future growth it would actually have to be defined by the teams that are able to adapt to the institutional game?
Yeah. So Maker originally, more on like the crypto native originally. But we've been shifting more into the institutional side because that's where I'm seeing like a lot of the growth, like this next leg up in terms of adoption. Like you mentioned, stablecoins are 300 billion right now. We expect this to grow to more like 3 trillion in like the next 5 years. And what's going to be driving this is a lot of the regulatory clarity that's coming in from the US. Now institutions can actually get involved and like take advantage of the blockchain rails that really like enhance the capital formation allocation, and it's just much more efficient than TradFi. So yeah, we've been increasingly working with institutions. One thing that we've got a lot of traction on is a lot of these institutions are all launching their own stablecoin, or they're like partnering with some smaller cap stablecoins. And since with the Sky balance sheet at now 10 billion, it's one of the largest holders of USDC in on chain. And so we're able to do market making services for these newer stablecoins and really bootstrap them up to scale. So for example, like we work with PayPal ongoing since the like mid last year. We are doing market making, lending, lending liquidity for PyUSD. But we were also integrated in the, like you mentioned, the Robinhood launch. So Spark Savings USDG is one of the primary backing assets for the Earn program there. And it's sort of like this high liquidity tranche that we're providing like this base yield. And so here, yeah, so for them, they've gone with USDG as the stablecoin, and really they're wanting to bootstrap USDG as part of like them being a consortium member there. And so we're really able to help bootstrap USDG in the broader ecosystem and give them distribution in that sense.
To some extent, it seems that having this access to Sky balance sheet is like a bit of an unfair advantage for a lot of the Sky ecosystem participants, right? Because you basically, if you are able to underwrite the idea that actually DAO can approve, then you get access to significant amount of capital that you can test on these new ideas, right? So I guess like you guys are trying to leverage that to the greatest extent possible.
Yeah, exactly. So that is like even like launching Sparkland back in 2023, we were able to borrow the capital from Maker then, Sky now, and deploy it into the market, so that there's this kind of like cold start problem a lot of the time with lending markets where you need the supply side and the demand side, and it's hard to match them. So with the ability to borrow liquidity from Sky on demand, basically the lending side is covered. So the borrowers can come in hundreds of millions in size, brand new market, and we can scale it up. So actually a very good example of this was the Coinbase integration. So maybe not many people know this, but for that integration, Spark was actually one of the main LPs into that Bitcoin borrow product, supplying, I think it was upwards of like 80-90% at one point, as it grew from like 0 to 600 million in the months after the launch. And so this sort of like...
And this was supplying Sky stablecoin or?
USDC.
USDC.
Yeah. So we would bridge the USDC from Ethereum mainnet and then supply it into the Morpho market. And so for Coinbase, this was great because then the borrow side just filling up at hundreds of millions quite rapidly, we can on demand just in time put the liquidity in and set the rate so that you don't get these like rate spikes that are more common like bootstrapping these markets. So yeah, I think there's like lots of examples like this where we work with Morpho, and it's been a very good collaboration.
Actually, just to add on, I would say like you made a really good point about like how it's a bear market right now and crypto native liquidity is thinning. But I think to Sen's point, crypto native liquidity, DeFi native liquidity is thinning, but stablecoin distribution has grown increasingly like massive. And I think this is a target segment that people don't really talk about because everyone's like, oh, DeFi native, or you're either DeFi native or you're looking at institutions. Sure, like DeFi native crowd is thinning. A lot of them are not even trading crypto anymore. A lot of them are in AI today. But we see a lot of new stablecoin distribution from payments, from fintechs. And I think this is a large segment that tend to overlook, because institutions, the traditional finance is going to take a long while to onboard fully, right? They're all investing, they're all looking deeply in how to build. But in terms of the size that you see on chain, a lot of that come from payments. And I think that's really where we double on distribution together, with Spark together. Coinbase is a good example. And I think Robinhood launch is also a really good recent example. And what you basically see on Morpho charts is regardless of market cycles, we're getting increasingly uncorrelated in terms of the size of the deposits to the market trend. So even though the market is getting more and more bear from a crypto native perspective, but the total number of deposits have been very steadily growing.
I see. Yeah, that's very interesting. I think like most people just look into some of the high level metrics, like for example, USDC, USDT market cap, and then like obviously still, despite all the kind of excitement about stable coins, like we still didn't see like much of the growth. And I think it's still probably because of the crypto market being sort of in a bear market, which reduces like some of the productive opportunities within like the on-chain landscape. But I think it's very accurate to say that a lot of the distribution pipelines have been built over the last 1 year. And I think even with institutions, right, like they tend to move a little bit slower. And if the positive regulation is made, let's say 1 year ago, then you probably expect to see more kind of results in the period of 2-3 years rather than like immediately. So I think there is like a certain time window for this to play out, but I think that the fact that the amount of assets that you manage is being less and less correlated to the price of major crypto assets, I think it's very interesting and important. And I think we also now touched on this like sort of high level comparison of DeFi native versus institutional game. I think there's also another comparison to make between kind of Asian and Western markets. I feel, especially like crypto today is, I think, in a somewhat unique position because it seems that it is one of the rare remaining deep techs that is still international and global. I think if you talk about like AI, robotics, most of the even quantum computing, it's all very sensitive geopolitical topic. And now we see more and more isolated markets and more fragmentation between East and West, but it seems that crypto is still somehow like the middle layer that connects both worlds, and therefore like I think plays a lot of importance for a lot of the crypto project go to market, and a lot of the volume capital is actually here in Asia. I think Standard Chartered was sharing some sort of not very precise statistics, but they estimated, let's say, USDT probably more than 25% of the holding, at least 25% of the holding is actually Chinese sourced capital. Like, so a lot of the whales, deep pockets in this industry are from Asia. A lot of the miners, exchanges, the biggest ones started from Asia. So this is still extremely important for any project's GTM, and you're leading the APEC business for Morpho. So how do you see some of the, I guess, different norms for operating in Asia versus Western market, whether it is like making deals, doing business in general, cultural norms, expectations? Can you just share a little bit more about this difference?
I can share more than just a little bit. this can be like an entire whole discussion on its own. Yeah, I think that's a great point. I think especially for DeFi generally, a lot of people, when they think about market expansion, Asia comes top of mind, and that response, I think, it's very natural because, to your point, there is a lot of crypto native liquidity in Asia. And I think that stems from the fact that, the early Bitcoin miners are Chinese players. So, today these people hold massive amount of Bitcoin. And when they were getting financing on the Bitcoin, in the last few years, they use, USDT. And then USDT was also the first stablecoin that was circulating amongst all of the top, global exchanges. So it's a very strong moat there in Asia. But I think, taking a step back, the Asian market itself, if we're just looking at crypto native liquidity, yes, it's, I think Asia contributes a fair majority to that. But if we're looking at, okay, let's target like the wall of credit and bring that on chain, then that's when the market gets a little bit challenging because Asia target audiences sit at two ends on the risk spectrum. Either you have very highly leveraged, very crypto native traders, or you have the ones that are very regulated institutional players, fintech players that can't move until the regulations give them green light, right? And the regulatory framework in Asia is just very different from the West in general. I think West regulation spirit's more like there's a comfortable level of view for players to experiment. And, until touch wood, things really blow up, then that's regulation enforcement. But I would say the same kind of open spirit, you also have that in Asia, like in positive discussions, regulators worldwide, in helping them understand, permissionless, non-custodial vaults. But I think in general, Asia regulators prefer more of a steadfast approach. So, we'll take a small step forward, test it out, and then we take a small step forward, test it out. And that's a bit trickier for on-chain infrastructure because it's infrastructure. When you change everything that comes with it. You change how people lend, how people borrow, the distribution stack change, you're looking at the entire underlying infrastructure change, which is a lot. So I think generally our strategy has been also two-tier. I think on one hand, we want to capture a lot of that crypto native liquidity today. And, we're doing that with a lot of product customizations that's built on top of Morpho Blue. And I think increasingly with Midnight, that's going to convert a lot of the liquidity that are crypto native onto Morpho today from Asia participants because it gives them assurance that's all fixed rate, fixed term. And then the other side of the equation, in terms of fintech institutions, I think we have a much more longer term approach where we want to work with the most ambitious players in this market that want to take a first step to say, I'm willing to invest together with you, alongside with you, in building what on-chain finance look like in this region. We just announced our partnership with HashKey like 2 days ago. And I think HashKey is a great example of that, right? They have built years of reputable track record and regulations, the largest regulated exchange in Hong Kong. But beyond just the regulated exchange arms, they have the cloud business, the RWA business. And the idea of the group level partnership is that Morpho will be the underlying on-chain infrastructure where they would bring the entire pipeline of RWA assets on-chain, distributed via all of the channels. It's not going to be, done like in 6 to 12 months. This is going to be a multi-year level where you expand bit by bit, based on regulatory green light and approval process. But it's generally a very different sales cycle. And I think probably just to summarize, the key difference as well between, I would say, expanding internationally is that you always have to think about like 3 dimensions, right? Is there a good product fit? Is there a good distribution? And then, who are you selling to, your target audience? And in this sales process, I would say Asia kind of, in its customization on all 3 levers. And most Western companies, I would say, underestimate the trust element that comes in. Right? I think for most Western companies, if you have a winning product, that just sells itself. In Asia, that's the baseline. You need to have a winning product, but you also need to have trust in the market. But trust is not something that is it can't really be built in months. So you have to think about creative ways. How can I build a distribution network that I can leverage my trust on, that can, that people already trust in the market and can distribute this. Or, just really having time in the market so people trust you along the way. So I think that's a factor that can get overlooked, especially for extremely crypto native companies, where they're not investing in years, but they want to invest in months. Then that would be a small gap there.
How to build trust in Asian market probably can be a TED talk in itself. But I think regulator, he's probably more cautious and often also looking for the lead from the US. And after the US is dominating the financial system and they dominate the regulation enforcement as well. I think nobody has as much capacity to enforce certain regulations as the US. I think there is also a little bit of fear not to experiment too much, to break away from the best practice that the main global enforcer of financial system wants to establish. So I think once we have a more clear signal and regulation from the US, everybody's very fast to follow. And I think in Hong Kong, you can feel a little bit very, very unique sentiment. I think Hong Kong itself like prides being like the financial capital of Asia, and then probably feels also more pressure and urgency to keep with the new financial trends. And when there was a clear signal that the US administration is going to back this crypto regulation, digital asset space, I think you could see things moving very fast over here with regulations. I think following pretty much the similar structure as the US, starting from stablecoin, and then like probably after what happens with Clarity, we would see more things happening in the region. I think HSBC and Standard Chartered got the approval to issue the stablecoin. To what extent it can be successful, I think still a bit skeptical, because at the end of the day, like HKD itself is a wrapper of USD. So if you do like HKD stablecoin, like it wouldn't be much difference to holding USDC. So unless you build the ecosystem around the stablecoin so that people can do more with the stablecoin itself, whether it is access to yield, trading, investing, and so on. But if there is a cautious approach towards building the ecosystem, then I think it's very hard to build competitive advantage for Asian stablecoins versus the USDC, USDT, or the general like the US stablecoins. But yeah, Sam, how do you think about like the Asia versus West? I see like you're obviously here, so you are keeping an eye on this region. You spend, I assume, relatively decent amount of time visiting major conferences in the region. So how do you think about the strategy for this region, and what do you notice to be a kind of like different in terms of the reaction you receive, or maybe like even the narratives being discussed compared to like what are you typically discussing within your circle?
Yeah, so we at Spark are kind of straddling both worlds. So we have business with a lot of like American companies, but also in the APAC region. So like as examples of like as Shan mentioned, like there's a lot of like OG Bitcoin holders in the region, and so like one product that we have catering towards this is providing like financing to institutions in the APAC region through our OTC Bitcoin lending product. So there's that, and we're financing like Bitcoin miners, prime brokerages, as well as looking at like consumer Bitcoin lending products as well. So yeah, we definitely have a lot of coverage across like both markets, and it's kind of like it's similar, but it's like there is differences. Like the regulation is kind of like the big difference. Like a lot of the American companies, they move slower, but once they come in, they're going to come in size. And I think like one of the areas that I think is going to be driving, I mentioned the 3 trillion stablecoins in 5 years. What's going to be driving this is payments finally coming on chain in a big way. Like it's just such a superior technology using blockchain with like near instant settlement, 24/7 markets, and so being able to have a global market like this that's always online is incredibly important. And so the legacy system, it's got lots of middlemen, fees. It's very slow. Like sending like cross-border payments, remittances. It's like the existing systems for doing this are just like painful, and they have like massive fees. And stablecoins are just like, it's just the obvious better rails to be using. So yeah, I mean, there's it's similar, it's different in a lot of ways, I guess is kind of the bottom line. But we're really excited, like not only APAC region for a lot of the existing business, but also that America is finally getting the regulatory clarity that will enable this industry to really hit scale.
I definitely agree that stablecoins are clearly better than fiat in terms of like being the medium to do payment transactions, like just the amount of optionality that you have holding stablecoin and the amount of control that you have. Like it's something that is just, I think, order of magnitude better than the fiat technology. And I think the only category where stablecoins are worse than fiat is access to investment opportunities. I think because of the things that, the things that we talked in the beginning, because now like a lot of the productive opportunities are still limited to endogenous assets. I think we now have like a lot of the stocks being issued on chain, but even when it comes to these representations, often the legal structure for issuing these stocks, it's not giving you really the real rights and peace of mind, like when you buy it with the brokerage, where you have like a clear separation of the issuer, like who is actually owning the asset. I think in a lot of these tokenized stocks, it's still kind of wrapping, trying to do it fast and issue it as soon as possible, but then you don't really have the real rights like you would have with the traditional assets. But I agree, it's for now. I think it's going to definitely change over time. And I think once this access to investment opportunities kind of equalized, I think there is very, very hard to find any category where fiat would be better than the stablecoin itself. And I think maybe like to transition to the next topic, Sam, you're closest to the end user here, right? Because you're the one that is taking opinionated approach, underwriting, trying to open like some of these like new borrower demand markets, especially consider that you have privileged position of having like good amount of assets that you can tap into. So I guess like you spend most of the time trying to figure out like the bottleneck of the borrower itself. I think for a long period of time, it seemed to me like money markets, at least I don't have the data, but my assumption would be like 90% plus is just facilitating the demand for some sort of leverage, which is mostly associated with leverage trading. But you so far mentioned like quite a few use cases that are just pure financing opportunities. Like even when you talk about the BTC miners, I assume they have demand that is not associated with trading itself, but they actually look into maybe finance operations and whatnot. So can you just share a little bit more? How do you see the who are the borrowers in the system so far, and what is kind of the structure distribution among these use cases?
Yeah, so the leverage traders that you mentioned, that was more of a common use case in the past. We estimate this, and so we're looking at crypto over collateralized lending. This does not count like the looping use case. For that type of borrowing, it's about 35% crypto hedge funds that are using DeFi lending markets right now, and the remainder is it's like maybe 50-something% is these like a lot of like OG crypto users who want to leverage their ETH or Bitcoin. That's kind of like the other major segment. And then there's like a tail amount of users, maybe like 10% doing other types of activities. But yeah, those are two of the largest segments for DeFi lending. We see like it's a more and more sort of like institutions that are getting comfortable with DeFi lending. This was, I think, more of a problem in the past, but we do see more comfort there. But for these markets where they still prefer like sort of more old school, like the Anchorage integration that I mentioned, they want to keep native BTC in custody. They like, there's a number of features that they like in there, such as like 24-hour margin calls, like this very like white glove service. There's still, that market is actually still much larger than the DeFi lending market. So it's more, we looked at these numbers a few months ago, so maybe they've changed, but like we estimate like maybe 10 billion in like crypto native lending, but the market for like OTC off-chain lending against Bitcoin primarily is more like on the scale of like 20 billion. So what we want to do is bring these people on chain as much as possible, because while we will facilitate OTC lending, there's a lot of overhead with it, and it's a very like human oriented, like lots of like messages and phone calls and stuff. And really like we see DeFi as like where this is all going, just because you get this like global market of liquidity you can tap into. But what's been missing up until recently is there's missing infrastructure. So fixed rates are like quite important for institutional borrowers. And so they don't like the variable rate lending markets where the rates can spike, and it just creates uncertainty for them. So with the launch of like Morpho Midnight, I think this is going to be a big growth area, because like our borrowers, we increasingly, I mean, we'll cater to both. It's whatever their preference is, but I think over time they're going to get more comfortable with coming on chain for this type of stuff.
And I guess like just to follow up on this, Sam, like when it comes to the facilitating the leverage, I guess there are also substitutes, right? Like for things like you mentioned 35% hedge funds. I assume that was mostly like the looping trade, like trying to get leverage yield exposure, which is probably something that doesn't have many substitutes beyond money markets. But when it comes to like leverage into your ETH or BTC position, like I guess you have a lot of substitutes. You can just go to the Perp exchange and get leveraged exposure to your ETH and BTC. Like, what do you think is Perp market clearly better for this second user behavior of like leveraging your exposure towards like some particular asset, or do you think that it is just the arbitrage between these two markets such that when funding fees spike in the Perp markets, like people come to borrow more in the money markets and vice versa? Or how do you actually think about these substitutes?
Yeah, so they're definitely different. I think like Perps is more of like a retail product. So where like the hedge funds, like where they will sit normally is they will borrow from like wherever. So part of that is like a DeFi capital, but it also is off-chain loans, and then they're supplying the liquidity on the short side of the perpetual futures. So basically facilitating the retail demand. But yeah, I mean, like, so derivatives are not the same as like a spot market. So like both of these exist in TradFi. I think both of them have their places. So yeah, I think that's kind of like how that shakes out.
And in terms of the bottlenecks for growth right now, where do you see them, Sean? Like, do you think that I think for Sam, it's probably more about like finding the borrowing use cases, because like they have like the balance sheet from Sky that they can tap into. But you guys are kind of simultaneously building like both the lender and the borrower market, like into trying to introduce like more curators, more assets on chains. Do you think that the bottleneck is now on the lending capital, borrowing use cases, or like the amount of the type of collateral that is being offered? What do you see kind of, I guess, is the largest growth vector going forward?
I would say it's loan origination for sure. I think that's
origination.
Like essentially borrow demand. We see a lot of stablecoin liquidity, and they all want to get yield somewhere. So I'd say borrow demand in the past probably concentrated amongst, to your point, crypto native use cases, a lot of leverage strip trading, but that market's very cyclical, right? It goes up and down based on like Bitcoin prices, for instance, and how we have been managed to solve that is through distribution, as well as through Morpho Midnight fixed rate fixed term loans. Distribution is clear, right? You're targeting just essentially non-crypto native users that routing stablecoins. They want to get financing in a way and get financing stablecoins. That's where we see a lot of new demand, borrower demand from. And I think the Morpho Midnight, this part is really going to unlock like so many different kind of loan origination that can be possible. I was just really not like it took, I would say, crypto like 7-8 years to get here, because before there wasn't enough sophisticated users on chain to underwrite both sides of the market, on both on supply and borrow. But I think now we're ready. Like to what Sam has shared, even just a simple, not simple, but like the OTC houses that facilitate tons of trading volume today, and they want to borrow a lot of stablecoin on chain at very attractive rates. There's a large demand for that, but it's hard for them to do that because fixed rates is non-negotiable. They would never do it on floating rates, variable rate markets. And then there's a lot of structural designs that you need to solve. Native BTC in custody, margin calls, 1 out of 3 private keys that stays within maybe the collateral holder. And now I think with Morpho Midnight, we've built this infrastructure that allow a lot of this different primitive to be expressed on chain. So it can really reduce all of the middlemen and cut out all the paperwork that you need. So this is going to be route in stages, not all at once. It would be fantastic if we can do it all at once. But it will be route in stages. And then this will allow so many new different types of borrow demand to come on chain. And then, you'll have both sides of the market. And this essentially will create that liquidity flywheel that we want.
I think like the fixed rate is quite important. I think when it comes to even just like leverage trading, even with the perps, right? Like it's also always like a variable rate, and sometimes, especially like in extreme market situations, like it really doesn't reward somebody who took like the right position. I remember when there was like in 2022 the Terra Luna crash. Think a few months before the crash, I decided like to kind of build the short position on Luna, unfortunately on FTX, and then I remember like the crash finally happened and the rate exploded. Like I couldn't even make much money on the short position because the rate just went skyrocketed, right? So I think I felt like. Damn, I didn't even get rewarded for like being right about this, because at the moment when you're right, like they usually like the rates like just reflect that immediately. So I feel like there are definitely a lot of use cases for that fixed rate would enable that are not possible with variable rates. But I'm also curious, like how come like so far we still didn't get fixed rates? Like you mentioned, like. Just now like 7 years of history evolution. I think like probably if you look from really like the first days of lending market, it's even longer than that. Like it's been always like variable, like even like moving from pool based model to modular model, it took a while, but then we are still with variable rates. We are still with uniform terms, like no differentiation in terms of the user profile. They're like still quite a few missing elements, it seems. So what was the reason that fixed rates never managed to take off, like in both of your thinking?
Yeah, maybe I can take that one. So like it comes back to this problem that I mentioned, this like cold start liquidity problem. So there has been like fixed rate platforms in the past, like some peer-to-peer matching, but the pooled lending market really took off just because it was a place to really build liquidity. And now with Sky's position as having this large balance sheet that we want to allocate, it means that the lending side is basically solved. So with this just-in-time liquidity through Morpho Midnight, as soon as we can source the borrowers, we can fill the lending side. So you don't have to have idle capital there waiting for borrowers to come in. And so like I think this is what's going to be different about Morpho Midnight versus previous attempts on this. Yeah, it's really just this cold start problem, and like Sky's balance sheet is really the key to unlocking this.
Any further thinking about like the fixed rate in terms of like either the problem for bootstrapping or like in general like the new use cases that you would think of?
Yeah, I would say liquidity was really a key problem before. Liquidity was thin. You had to bootstrap both some markets, which is very hard to beat fixed rates on top before. So everyone kind of aggregated liquidity to one venue. But I think another reason is really just how on-chain has taken off fully, right? And in the past, I would say just the variety of market participants was small. It was a small cluster. Everyone kind of knew each other if you've been in the industry for a while. The crypto native or DeFi native liquidity was trading the same subset of collateral. But I would say what fixed rate really opens up is the full addressable markets. So to the different kinds of collateral that I talked about earlier. I think that's really what is most exciting. That for the first time, we're now able to move fully beyond crypto-backed loans. And we're going to get so much more different collateral types that's running on-chain infrastructure. So I think that's the incredible part. And now we have sophisticated users that can underwrite risk on those parameters. Now we have distribution channels that can plug in. So there's borrower demand that they can plug in these markets to, and supply coming on top. So it's I think one way to summarize this is I think change take a long time to see, but once it happens, everything happens all at once. And I think that's what we're really seeing in the market right now.
I think like Morpho Midnight seems to be like one of the most ambitious attempts to resolve this problem in the fixed rate market. So you really set expectations high. It will be very interesting to see how things play out. Like also for Sam, like to what extent do you think that something like Pendle is substitute for this sort of like a fixed rate behavior. I guess like the original idea of some of these interest rate trading protocols was that you could also get more predictability into your position. To some extent, I believe, especially in some things like, let's say, fixing your funding rate on Perps with borrows, like it's still very hard to bootstrap the liquidity or like kind of bring this closer to the end user to make it intuitive and make it like a habit of using this sort of like solution. It seems a little bit more complex, but how do you think about like the general, like, I guess like the level of this being the substitute for Pendle versus like opening up like access to new market opportunities?
Yeah. Yeah, so like Pendle's great. Like, I think they've built a great platform. It's really finding its product market fit with more the lending side for fixed rate. But it's similar in some ways to this different types of constructs, such as like a Morpho Midnight. There are some important differences about needing to like build liquidity in certain ways with Pendle PTYTs. That are not really, it's just like a different type of like market. So for the fixed rate loans, the construction is just the most natural, extending out of like what we're doing with the OTC Bitcoin loans. Like really, yeah, like as I mentioned, like you have the fixed rates, you have the potentially like these 24-hour liquidation delays, margin calls, stuff like that. But as well as like the compliance also needs to be there. DeFi lending, one of the issues it still has is that the counterparties are I mean, a lot of the time we do know who they are, but like it's not the same as like how lending works in TradFi, where you have known counterparties and it's like an actual like legally enforceable loan. It's not like if there's a bad liquidation and there's some loss, they can just not pay the money back. So it's a lot different. So I think, we need all these tools on chain, and there's no reason why we can't replicate this all on chain. And so, I think Morpho Midnight's like a very good step to getting the tools that we need. And then I think some like further additions there as well, like with the compliance side, and then like kind of connecting it more into the legal system with like known counterparties is also a component that I think we'll need. And once these are all in place, the capital efficiency, sourcing liquidity on chain wins out over like one-to-one OTC deals.
I guess like maybe like what are the kind of missing pieces in the money market protocols? Obviously, like the fixed rate being one of them. Uniformity of terms for the users, where the protocol doesn't distinguish between like higher value users versus lower value users. Like I think like if you think about the exchange business, right? Like every exchange has VIP program to make sure that their like most valuable users are happy, they have access to maybe lower rates. But then like with money market protocols, everybody is treated in the same egalitarian way, which is kind of like not very business savvy. And then like what would be the third one? I think the third one would be like probably the fact that the money market protocols now manage to tap into undercollateralized lending, which probably is also something that would be very hard to achieve. How do you think about these three? You obviously have strong opinions about the fixed term loan, and you guys are going directly to try to resolve it. But in terms of the other two, like, or if you have any other like idea around the missing pieces, do you think that this is something that could be resolved within the existing framework of Morpho, where you would have like some allocate this decision to curator to make these sort of decisions about having non-uniform terms for the borrowers, or like going into different class of trying to do some under-collateralized lending? Or do you think that this would require like new primitives in the space?
I would say probably 2 points there. I think you raised a very interesting point about, how exchanges have all of these VIP business units and they have offered like more hand-holding experience compared to like just on-chain uniform rates. I think this really goes back to like why distribution is so important for us, because we see ourselves complementary as to, platforms like exchanges. They're building all of these on-chain products and they still own the relationship with the end customer, right? That doesn't change. But now they're able to plug into on-chain infrastructure and get much cheaper rates. So it's best of both worlds. They service their clients better. They still own a relationship. And if they want, they can still add, a service markup for the VIP users, which a lot of users will be happily able to pay because you already have a very cheap rate and they're just paying for the added service. So I think that's a key part, and really, I would say doubling down on distribution because it allows so much more market participants to be on the same network in a way that deepens liquidity and, not see that as like just two separate network modes that don't talk to each other or share liquidity. And then the second point I would say is a lot of the trust intents and a lot of the interest rate model, the differences in setting those, a lot of that will be solved with Morpho Midnight. Right? That's our goal. With Morpho Blue, that's one interest rate model. And with all of our conversations with the top global institutions, asset managers, banks, brokerages, that's not what they want to build on. They need to be able to set interest rates based on their own terms. So that would be what Midnight solves at that primitive. So everyone's able to express their intent, how much they want to borrow, at what terms, under what gated KYC credentials that might be. So this is what we're excited about, and it will take time to develop, but we're full hands on deck.
And Sam, how do you think about allocating your research in terms of different efforts and different chains? Do you think that the liquidity is still mostly sitting on Ethereum, or do you see much potential beyond EVM chains? How do you think about focusing your effort on these different layers? I think at this point, we're already in a stage where we don't have too many new chains launching, which is good, obviously, but there are still a lot of good contenders. I think it's just that some chains are more positioned towards the consumer. I'm not sure still whether anybody managed to challenge Ethereum in terms of the depth of liquidity and capital. Do you see also this sort of behavior with the new assets, new capital that is coming in, which is kind of gravitating towards the same layer? Or do you see that somehow they're different, somehow this analogy doesn't work with the new kind of set of users, institutions, and new players in the game?
So Ethereum is still the hub of liquidity. It's also where Sky governance sits, so it's kind of our home base. How we view these new chain launches, we're focused on the ones that are attached to distribution. So it could be either in Coinbase or Robinhood example, they have the chains associated with them, largely view it as an extension of the exchange. And so really, I mean, as long as there's demand coming from the exchange, we're happy to fill on the lending and borrow side. But yeah, I mean, there's a lot of chains that are launching now. Increasingly, the payment space is competitive. Tempo and Stripe is an interesting case there. But yeah, I think Ethereum's really cementing itself as the neutral hub where the liquidity is consolidating, and then it's available on demand on the various chains. So we will bridge stablecoins to the point that to meet the demand just in time, basically. So yeah, that's more or less how we view it.
I feel when it comes to this topic, that it is becoming clear that the chains that are focused on consumer apps are in a somewhat tricky position. You can even see it with the example of Polymarket, right? Nobody cares or knows that they are on Polygon, or whether if tomorrow they would change the chain, it wouldn't actually matter that much for their user experience, because for these consumer apps, like you don't actually have a lot of these importance in terms of composability, access to broader like integrated ecosystem like you have in like a pure DeFi and capital management businesses that Ethereum tends to dominate. And a lot of the tooling stack for abstracting away the chains is becoming very good. Like I think the reason why Polymarket is so good at abstracting away Polygon is because of this like payment deposit solution that they use, which is FineXYZ, that fully abstracts the gas token depositing flow and whatnot. And it seems that at the end of the day, for the underlying chains, it's mostly about you either build a mode by having the liquidity and strong DeFi ecosystem, or you have to build products yourself, and you cannot rely on consumer apps as kind of like a sticky use case or like something that could essentially like bring that much value to your chain. And yeah, this was a small digression, but then like going to Morpho, I guess the interesting thing is you guys, it's also a big compliment for you guys. You managed to partner with both Robinhood and Coinbase, which are going head to head in many things and probably don't like each other that much, like see themselves as big competitors. And you guys being the preferred infrastructure for both of them, I think it's a big recognition and win. And it's also, at the end of the day, like you're unbiased infrastructure. So it's not like you have to take sides, but if you can share a little bit opinions in terms of what you're seeing with the earlier adoption in the Robinhood chain and how different it is from what you've seen in the Base ecosystem. Maybe it's like a bit tricky to comment on because you have to complement both, I assume. But if there are some like opinions that you can share in terms of the maybe different behaviors that you would observe on these two.
So I'd say both are great partners, first of all. The launch of Robinhood chain and with Robinhood, it's fairly new. I think we launched that in mid-June, so it's been about a month. And user behaviors on both. So stats-wise, I think both are very large distribution channels, right? Just by sheer numbers, I think that goes without saying. Like on Coinbase, there's more than 1 billion. And just BTC backloans alone on Base. And on Robinhood, their users have deposited more than 300 million in just a few weeks. So I would say at the very baseline, there's great distribution for both. In terms of user behavior, I think that would really depends on. So I'm only going to speak for products that we have just launched. Right? I think there's going to be more in the market, but at which we'll see in upcoming product announcements. But let's just say the Coinbase one, for example. I think it's actually a very interesting user profile that we have not really seen in crypto native. The average Coinbase user that goes on to Coinbase app and use Borrow and in the simple earn profile or UI, they are, leverage use case could be one, but I think we also see a lot of people who are just generally very long-term holders of BTC or ETH or other tokens, and they want to get liquidity, right? Financing, and there's very high capital gains tax in US, generally in Western countries. So people are not trading as much; they're not buying and selling as much. So financing, I think, becomes a very, very natural use case, and Coinbase has built a great ecosystem where they make spending on stablecoins so easy. So when you take financing on the stablecoins, on the back of a BTC collateral, you can now just spend it and buy a coffee, can pay for a housing mortgage. And these are your average 9 to 5 users that hold some crypto in a portfolio. They're not the everyday traders that we usually see in DeFi. And this is, I think, a very interesting target segment that we have seen very, very sticky liquidity, and that is genuinely just growing over time. So for Coinbase, launch BTC backloans first. They're rolling out to more and more different collateral. And we also launched Earn with them. So they first had a prime vault, and now they have a high yield vault. And I think the high yield vault is essentially lending to more higher yielding under collateral like Ethena, USDE. And it's a slightly higher risk profile, but it also caters to a different target audience there. And I think that's the first product that we've launched with Robinhood. There'll be more to come. So, yeah.
I think like this, it's quite a good explanation that US users are probably like much less generating much less volume per unit of capital than like much lower turnover than the Asian users. I wasn't thinking about it through tax lenses and this being the primary reason, but you're probably right. I guess it's either tax or like in general like a risk attitude. But it seems that the US user group is more like deeper capital base and lower turnover, and the Asian user groups are much higher turnover than any other market.
I would say you have the same profile of what Coinbase users are in Asia, but they're not on exchanges. They're usually in hardware wallets.
I see.
And so that's a lot of ultra high net worth individuals that hold their crypto onto these hardware wallets. So this is a segment that we are launching more borrow products with in Asia.
I see.
So finding a different distribution channel to each market.
And Sam, like if I understand well, like you guys are also working with both Robinhood and Coinbase in Robinhood ecosystem. Like the saving product is the flagship thing that you're pushing, and with Coinbase, like you're the you mentioned you bootstrap the liquidity. Are you guys also a curator, and how do you in general like see the values of these ecosystems and general like dynamics?
Yeah. Would say that like where we're positioning Spark Savings in particular is the product that's been integrated with the Robinhood Earn Vault, and we're really positioning this as like very sort of trusted, safe, reliable base yield within the ecosystem, and it's precisely because we have so much liquidity, we can make very strong guarantees about like liquidity. This is a big concern. Like even though markets may still be solvent, like users they'll panic if there's like some sort of like loss of liquidity. So ensuring that the vault is always available and highly liquid is incredibly important. So we're really positioning Spark Savings. In this case, it's USDG, but we build it on top of any stablecoin, having these strong guarantees. And what powers this whole thing is the Spark liquidity layer, which we've been building up over many years. This is automated, non-custodial software that will move the funds around automatically. So we can project sort of what the liquidity demands are and make sure that it's there. So if we'll have like initial tranches that will be local to Robinhood chain, but if there is some sort of event that occurs, there's like usually like a panic or something that causes liquidity loss, we have the Sky balance sheet to draw on. So our system will automatically borrow USDS and then can like swap it to USDG and then bridge it through Paxos over to Robinhood chain and then fill in this liquidity. So the users, we act as like a lender of last resort on the collateral that we have underwritten. And so this is really where we're finding this fit. So I'm a big believer in like, I think the DeFi mullet thesis is correct. Like you're going to have likely mostly consumer apps that are centralized that then plug into the blockchain rails to source bulk liquidity. And blockchains, I think the payments use case is a little bit different, but like I think blockchains are increasingly going to be more of like a back end, like massive liquidity type infrastructure. And where we're positioning Spark is to facilitate the liquidity movement cross chain.
And maybe like follow up for you, Sam, on this, like you also come from Maker DAO. You have experience hands-on working on stablecoin, working with a lot of different stablecoin providers. Like Sky seems to be now more positioning as a yield product rather than the stablecoin itself. Like there was obviously a lot of talk in the market about the different stablecoin providers who captures the value, who can challenge Circle and Tether. Like I think the idea of consortiums started with USDG probably, and now there is also like OUSD that is going even more broadly. How do you think about like this stablecoin landscape, and do you think that it is winner take most type of market, or do you expect that somebody with strong distribution like Robinhood could actually like pull USDG to become like even somewhere competitive to Circle, or if anybody else like Robinhood profile comes to this game, like decides to go with a new stablecoin? Do you feel like we would just have a lot of new private monies, or do you think that the market would just gravitate towards like some solutions?
Yeah. So these are different products, I think. So if you have like USDC and USDT, they function more as like a full reserve narrow bank in a way, in that the assets are just held in the lowest risk option treasury bills and bank deposits. And so USDS is fundamentally different because it operates as a fractional reserve system where like we do lending and stuff like that. So these two are very complementary. So like we are not so much competing with Circle, but more like providing yield on and liquidity on top of their stablecoin. So this is really where I see our fit. And with all these newer stablecoins launching, it's a very hard thing. I think they're going to have a big challenge, like overtaking Circle Tether. I think for onshore, offshore stablecoins, they have a pretty big moat. But there's still going to be like there's a big market, and it's going to grow a lot. And so there will be these like pockets of different types of stablecoins where the issuer wants like more control. They want to earn the NIM on the asset, the backing assets. And yeah, really, we're just positioning ourselves as like this neutral sort of liquidity facility that operates blockchain natively.
Got it. Yeah, and I think we can slowly wrap up maybe with one more question in terms of the making projection for where you see your respective protocols in the next, let's say, 3 to 5 years, starting with Morpho.
Yeah. So actually, just to add on to Sam's previous point, I think that's also a very interesting growth of non-USD stablecoins, right? As the market grow bigger and bigger, there will be demand from local distribution networks that, their users are depositing, let's say, in Asia, like Hong Kong D or Singapore dollars or Japanese yen. And these non-USD stablecoins were also increasingly getting on-chain. So I think that's also a very big growth factor in the coming next 1 to 2 years. Japanese yen, for example, I think the carry trade has been in trillions in TradFi, but it couldn't do it in DeFi because there's never been fixed rates. So I think there's a lot of pockets of opportunities there beyond just like USD stablecoin distribution.
You guys also have like the partnership with Societe Generale, right? Like with the Euro stablecoin.
Yeah, EuroCV. And so for example, EuroCV D-Block launched a EuroCV Unvault in the platform, and that crossed like 100 million in EuroCV deposits. So there is definitely strong demand in the market tailored to local distribution networks. So distribution is king, I would say. And coming back to your last question, I would say in 3 to 5 years, if we do our job well, we won't even hear about, on-chain infrastructure. We won't hear about DeFi in general. Like, where we really want to be is what HTTPS is to internet, right? But Morpho to the wall of credit. So it will just be so invisible and plug in to distribution networks across the world, across different collateral assets, with different professional asset managers coming on chain and underwriting those new types of collateral. So I think that's really where we want to be 3 to 5 years if we do our job right.
Yeah. So for us, as I mentioned, I think we're going to like 3 trillion by 2030 in terms of stablecoin market cap. And within this growth, I view USDS is already the market leader for yield options in the space. And so I think this position is going to continue to consolidate. That's usually how these things go. And so as the market grows as a whole, first, and like for emerging markets, for example, like first you want access to the dollar. But then what's the next natural thing you want to do? You want yield on top of it. And so we want to position ourselves as the go-to reliable, safe yield in the space. And so I think not only at the very least, we will grow proportionally with the market, but we also want to grow our share of the market as well.
I see. Yeah, very, very impressive. Yeah, thank you both. I really enjoyed this conversation. Congrats on all the recent progress. Hope you managed to get all the deals done in Hong Kong for these few days, and hope to see you soon again. I think with this we can also close this episode. Thanks everyone for listening, and keep joining us the next time.